Hello everyone, my name is Thomas, and in today's video I will talk about bid-ask spreads and how they are influencing our trades. I will share my screen and I will show you a few examples. But before that, join me for a meeting in Hong Kong. For those who don't know, even Hong Kong was already handed over to China in 1997 from British. Unfortunately, the border between still remains, so this big building in front of us, this is the cross-border Futian port. This is one of the, I think, 3 or 4 places you can actually cross the border from mainland to Hong Kong. And hopefully the process will be smooth today. Sometimes it takes half an hour just to cross. So this is the way to Hong Kong. In a few minutes I will not be able to do any recording, so I will stop here. So I successfully crossed the border to Hong Kong, which is right here on the map. In the north part you see this is the gray area, this is Shenzhen, and it's China mainland. The white part below, this is Hong Kong already, and in the very south it's Hong Kong Island. This is this place where actually the meeting takes place today. So how to get there? Basically there are 3 variants, respectively 4. One obviously is go by car or bus or taxi, which can take you directly to the Hong Kong Island. Then there is since last year another option, which is the fast train, which actually stops somewhere here in Futian station in Shenzhen and go all the way here, and it making it just in about 14 minutes, and then you need to go again by either subway, either taxi to wherever you need to. It's the fastest probably way because you do the immigration part already here for both Hong Kong and China mainland. So altogether 14 minutes is very nice. Price I don't know yet. I hopefully will try this connection first time today afternoon when I go back from the meeting. And the other 2 options are either through the border crossing. Where I go today is the Futian crossing, either the Luohu crossing, both in Shenzhen, both accessible by subway from Shenzhen side, and as well both connected by blue line on the Hong Kong side, which you can continue down to south. So today I will use this part. So as you saw already, I go by taxi to Futian crossing checkpoint. This is because it's very close to my home where I actually live on Shenzhen side. Here I crossed, so now I'm here, and I will go by blue line all the way here to Shep Kip Mei station. It will take probably around 30 or 35 minutes to get here. Here I will jump to the green line, go to Mong Kok because it's easier to be transferred here, and from here I will continue down all the way to the Hong Kong Island, to where my meeting is. It seems like quite complicated, but these transfers actually right here and as well right here are very convenient because you don't need to even change the platform. It's directly at the same platform for the direction you want, so it's very convenient. Takes just a few minutes. So here we are in the heart of Kowloon. This is Tin Cha Che station place. It's a very bustling place, as you can see. A lot of people here, a lot of buses, a lot of car traffic. Definitely, if you want to do some shopping, this is the place to go. All this Nathan Road is full of shopping centers, so either shopping, either window shopping, this is the place to be. Right here you can see as well a mosque, which is behind the bus. Now you cannot see, now you can see. And what is very interesting, that right behind the mosque, on this side of the road, there is a park actually. So if you are tired from the shopping already, it's very easy, just cross the street, go up and right, and there is quite big park, very silent, very nice, very green, very fresh. So it's very easy to get out for a minute from this concrete jungle and with millions of people and you can be in a minute in very silent, nice, fresh place where you can rest for some minutes and then go continue if you like to. This view is simply so beautiful. I couldn't resist to come here for a few minutes and take some video and photos here. I visited this place first time in 2008, and since that time, 2019, 11 years, I was here probably more than 100 times already. But anytime I have a chance to come here, I always stop for a few minutes to take some videos, some photos here. So let's look at bid-ask spreads a little bit closer in the platform. This is Interactive Brokers platform demo account, so I will demonstrate you here on options I put here, how the bid and ask spread influencing the trades and how they influencing the stop losses and expected profit and loss results for different price movements. So let's look initially what's the underlying asset. So it's SPX. This is ETF, which is copying S&P 500 index, and today it reached roughly 3,100 points. All the options here below, you can see they are all targeting this underlying SPX. They have different strike prices, they are different put and calls, and they are as well having different days to expiration. It's either 10 days, either 35 days as an example. SPX is one of the most liquid ETFs on the market, if not the number one most liquid. But still you can see difference between bid and ask is roughly 40 or 30 cents for each option. What does it mean? It means that if you buy and immediately sell or sell and immediately buy, you already losing $30 or $40 on one option, even if the price didn't move at all. This is just because of the bid and ask spread. This is something what you need to count with, but those of you who trading, for example, stock, you probably rarely thinking about this. But for option trading, and especially for trades using some multiple options in one trade, such as butterfly, iron condor, and some others, you need to really look at it very closely, and you have to as well probably avoid trading options on the assets which are not so liquid, where the spread of bid and ask is too big. So let's look here. For example, the first one or second one, let's look the second one. 30/40 option has a 30 cents difference in the option price. It means if I buy it, I pay $530 for this option, multiplicator is 100, and if I immediately sell it, I will get only 500. So $30 lost in 1 second without any price movement. To make money, the option have to grow at least 31 cents or $31 to be break even and start making profit. I think this is clear. And if you look at this difference, very interesting is that the bid and ask doesn't change much with different type of options, even those who are multiplicatively more expensive, such as this one. So here the difference is 20, here the difference is 30, and here the difference is 40 cents only. For any trade where you're using only one option, you probably will accept the bid-ask spread as okay. But if you look to some trades, for example, as a bull put. So bull put, if I look at the one which I prepared here, which have 10 points wide spread. So 30/40 is the short one, 30/30 below is the long option, insurance option. So there is 10 points between, so there will be 1,000 as a margin to open this trade. Look at the bid-ask spread here. Here it's as well not as much in absolute values, it means it's 60 cents, but if you look percentage wise what's the difference between bid and ask of this option, it's actually half or 2 times if you take it from the other side. What does it mean? If I, for example, go for short bull put, it means I get the premium, I go for credit trade. It means I will get only 60 cents, respectively $60 for such trade as a premium. But if I want to close this trade, I will have to pay $120 if there is no price moving at all. This is quite a lot. This is quite a lot, so you rather not close this trade before the expiration, and most likely that's why you are doing this 10 days only to expiration trade, because you count with the fact that majority of the trades, such as 90%, here in this case is even 98%, because there is just 2.6% delta probability to end up in the money. So you counting the majority of the trades will actually expire worthless, so you will keep your $60 and you don't need to close this trade. But in this few percent of probability, like 2.6% probability, you will have to close this trade, and you will probably close it because the price will move against you. So the closing of the trade will not cost you $120, but most likely will cost you immediately $200 or even more dollars. So it's substantially more than the price you pay or you're getting in the beginning as a premium. This is something you need to be aware. If we look to the trade, which is as well bull put, which using the same short option 30-40, but there is only 5 points wide spread, 35. Here the difference is even bigger. If we here talking about double, here we talking actually about 4 times more. What does it mean? If I open the trade, I will get premium $20. But immediately if I want to close it, I have to pay $80. So even without any price move, even when the trade is going my direction, just to close this position, I have to pay 4 times more of the initial premium. This is something what I would not recommend to do anybody, and this trade for me doesn't have sense. First of all, the premium I'm getting $20 is very small, and plus you have to count with fees you have to pay. So in reality, you will get something like $17 only, but you have to pay 80 plus fees. So you will pay roughly $83 to close this position, even without any price movement up and down. This is not efficient trade. This is something what I would not recommend to do. So what is the outcome? Outcome is that for very small wide spreads, or for trades which has very little days to expiration, typically the bid-ask spread is much higher percentage wise than for spreads created from options which has much more days till expiration or with a wider spread. This is one of the reasons why you need to look at it before you enter the trade, even if the underlying assets is so liquid, and as well if the options are so liquid. Still, if you combine them together like a pull spread or iron condor or other type of trade, the bid and ask spread already start playing big role. Just for illustration, here is 2 iron condors. So this is the put and call, the same here, just different expiration dates. You can see that for the short one, again with 10 days to expiration, there is roughly double what you have to pay for closing the trade comparing to the open, while here the multiplicator is even bigger, 4 and 5.9. This is just for you to demonstrate that for longer trades, actually percentage wise the difference is smaller than here. Another point which you need to be aware is when you're setting up stop loss, in case you are using stop loss for options, typical stop loss is set to 2 times or 3 times or 2.5 times of the premium gained. So let's take this trade as an example. Let's say I get $50 initially for buying the bull put. I am holding this bull put for 10 days. I got $50 premium, and I want maximum to lose $100, 2 times of the premium. So it means I have to set the stop loss on 3 times what the premium I get, to 150. Why? Because 150 is the price I will have to pay at the end minus the premium 50 I already get. So the final stop loss will be 100. This is what I wanted. So it means I will set up to the platform 150 as a maximum price for this trade. But I'm not setting it on ask, I'm setting it on bid. It means here in this line there would be stop loss set to $150 maximum price. Again, what does it mean? Already now, when I'm opening the trade, the price of bid is 110. So there is just remaining 0.40 or $40 to reach the stop loss. It means that even very tiny change of the price not in our favor will already hit the stop loss, even when the price here in ask side is still relatively okay. If we demonstrate it on this side, you can see it's moved a little bit now. So now it's 10 cents and 70 cents. It means 7 times more difference between bid and ask. Again, if I want to use the same analogy and I want to set up the stop loss in 2 times premium, so taking the same example, 2 times multiplied 10 is 20 cents, 0.2. This is my stop loss I want to achieve. To achieve this, I need to set up stop loss using 3 times, right? Because 3 times 10 cents is 30 cents minus the 10 cents I get as a premium in the beginning. I will end up with the loss of 0.2 or 20 cents. So if I open this trade now, hypothetically, I will get 10 cents and I will set up immediately stop loss here as 0.3 or 30 cents. I will be immediately fulfilled because already now there is 70, now even 80 cents. It means I cannot use the stop loss of 30 cents because already now the bid is 80 cents. I have no way how to achieve loss only 2 times of the premium. Simply there is no way how to do it because the bid is already so far from ask that even if I use 4 times, I'm still not able to do it. So this is something what you need to be aware that actually closing of option trades, typically no matter if it's your own manual closing or the stop loss setting, is very, very heavily impacted by bid-ask spread. I hope this video was interesting for you. You learned something new, and if you like it, please hit the subscribe button, hit the notification button, and see you next time. So time to go. The meeting is in Cintace. This is the place we are right now, in I Square building. So let's find it. It's probably no more than 2 minutes from here.
Longer.